money, 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 money. For that money, 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 money. That money, 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 money. Niggas turn on their brother. For that money, 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 money. That money, 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 money. For that money, 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 money.
Welcome back to the Anecdote Podcast with your hosts Ian Knowles and Mickey Brown.
Hola, muchacho.
So today I was thinking, we could talk about bonds.
Okay.
So, Mickey, what are bonds?
Bonds are just loans for governments. So, if the government says we need a $1 billion of loan to fund something, there's no guy who can loan them that. So just like with stocks, there's nobody who can buy a $10 billion company. So you sell pieces. There's nobody out there, no institution out there that can just loan the government $1 billion. So they just sell lots of tiny little loans to people, and that's what you're buying.
So what would be the point of buying a bond instead of a stock?
So your return on a stock is based on the value of those companies going up as the companies continue to grow, as the world continues to become more and more developed and more people are buying their stuff. The return that you get on bonds is just based on the interest rate of the bond. It's a fixed interest rate, so it's not going up and down with the stock market per se. It's whatever you buy that bond at, you're guaranteed to get that return. And of course the interest rate changes, but you're locked into whatever you bought. And if you buy a bond index, which is what you should do, it just has lots and lots of different bonds in an index, well, the values on that are going to change because the index itself is changing year to year. But the point is that if the market crashes, your bonds don't crash because the government still owes you what they owe you. Whereas, if the market crashes, the value of those companies has gone down, so your stock prices have gone down. But the government still owes you what they owe you, so your bonds do not crash.
Bitch better have my money.
Yeah, that is the only risk you run, is that if the government didn't pay your bonds, we're talking like an economic collapse situation. So other countries have bonds, and they have usually much higher interest because they also have a lot higher risk. If Vietnam has some bonds for sale, they might not pay those. I don't know.
That Venezuelan bond is pretty pricey.
Exactly. Yeah, that's a much better example. Vietnam is actually developing along pretty nicely. They're probably going to be the third best country in Asia here soon. They might become the third developed nation there, Japan being the first and South Korea being the second. But Venezuela, on the other hand, they haven't been showing any signs of progress, man. But U.S. bonds are pretty damn reliable. Also, that's what the majority of our debt is. The media always talks about China, and so there's a lot of people who think, if
the China man called on the phone and said, give me all my money back, then the U.S. has to shut down.
Then we all die. Yeah. So a lot of people think, oh, man, I heard China owns 70% of our debt and all that shit. No. 80% of the debt is owned by Americans themselves. Some of it is the branches of the government indebted to other branches of the government, mainly Social Security. But then a lot of it is the government indebted to just investors, people who bought bonds. And then of the foreign governments that we owe money to, a lot of them actually owe us more money than we owe them, like we are in debt to each other. It's all weird and complicated, and if you were to try to draw it out, it would look like a bowl of spaghetti. But
delicious.
Yeah, but the takeaway is that the majority of the U.S. debt is owned by American citizens like me and you. So the point in buying it is that if the stock market crashes, your bonds don't crash.
So then should I only buy bonds?
Well, the average return on bonds is only 5.4%. That means that it takes 13.3 years to double your money instead of a little over 7 years. If you were to put $5,000 into a bond index...
Index bond.
Yeah, but put $5,000 into a bond index every single year for 40 years. At the end, you would have, given the average return, $634,000. Which, since over that 40 years you would have put in $200,000, that means you still made a lot of money. But of course, if you were to put $5,000 a year into the Vanguard Total Stock Market Index Fund for 40 years, you would have $2.4 million. So that's a $1.8 million difference. So stocks just kick the shit out of bonds. which means that bonds aren't good for growth. They're good for diversification. They're only meant to help reduce the impact of a crash. The stocks are what's really going to make you rich. And also the return that bonds have been getting has been going down a little bit for 35 years. So they're still making money, but less and less and less over time, just because the interest rates are going down. So my advice, and this is where I differ from a lot of the conventional wisdom. A lot of the conventional wisdom out there is that, I mean, you hear different things from different people, but they'll advise you to start buying bonds like when you're in your 20s. They'll say, oh, when you're in your 20s, only buy 5% bonds for your 401k. They'll say your 401k should be 95% stock, 5% bonds. And then when you're 30, 10% bonds. And then when you're 40, 20%. And so on. And keep going up and up. Until by the time you're 60, they'll recommend anything from 30 to 50%. Well, and if you do a target date fund, like my Fidelity 401k offers a target date fund, they'll do something kind of like that where you slowly buy more and more bonds as you get older. I think that's pointless. I think that's stupid.
Yeah.
The purpose of the bonds are to make it so that when the market crashes, your money doesn't drop as much. But as I explained in a previous episode, you only lose money if you sell. And if you're not retired yet, why would you sell? That means that if you're not retired yet, you don't need bonds. There's no point. And so I say that perhaps what you should do is go about 30% bonds when you're within 5 years of retirement. Because during the Great Recession, the market crashed for 2 years, and then the recovery took a little bit over 2 years. So that, that's 4 years that your money would have been down, meaning that...
In the worst of times.
Yeah, meaning that if you turned 60 right when the market crashed, you would have had to wait at least 4 more years to retire. You didn't lose your money, you just had to wait 4 more years for it all to get back before you could retire. Whereas if you had been all in bonds, then you could have retired anyways, right? So let's say the stock market crashes when you're retired or when you're about to retire. If you've got 30% bonds, can you live off of that for a few years? Basically, since your stocks have fallen and your bonds haven't, if you sold stocks during the recession in order to fund your retirement, you're selling those stocks at a discount and you're not going to get that back. That's when you take a loss. The bonds, however, have not fallen, so you can just sell those. So, do you have enough bonds in your retirement account to last you a couple years? And you probably should. And for most people, that's probably going to be 30%. The richer you are, the lower that number should be. The poorer you are, the higher it should be. So the conventional wisdom is slowly buy more and more bonds. My attitude is wait until you're really close to retirement. Don't even touch a bond until then.
And use it as like retirement insurance.
Yeah, it's just to protect you from a crash. Just to make it so that if the market crashes, I can just sell my bonds for a couple years.
Can I wrap my car in bonds?
Yeah.
Will that work?
Yeah.
To avoid crashes?
And so I've brought this up on like financial forums and stuff, talking to guys that are actual paid advisors and professional investors and stuff, and see how they argue against me.
Professional roulette players?
Yeah. Well, the guys who argue against me, to date, their arguments have just been shit. Like when I was trying to learn this information, I went to them and said, hold on, why should I buy bonds when I'm in my 20s? What's the point? I was trying to learn. And they would just kind of get angry with me, that's a bad sign. If you're getting angry because I'm trying to learn, that probably means that you don't have a good enough argument to defend your stupid stance. The argument that I got...
think he is? Some guy who wants to learn shit or something?
Yeah.
You can't learn what I know because what I know is too complicated.
Yeah. The argument that I got to suggest why I should buy bonds when I'm in my 20s or 30s was, well, if the market crashes when you're in your 30s and you have a bunch of bonds in there, your balance won't fall as much, and so maybe then you won't panic sell. That's their argument.
Well, just don't panic sell, you fucking idiot.
Exactly. That's my defense. I said, the strategy that I'm going to use to prevent me from panic selling is education.
You know what you should do when the market drops? Panic buy. Because everything's on sale.
Yeah, that's exactly what I do. When it dipped earlier this year, I increased my 401k contribution to 75% for a couple checks. Just because might as well buy in a real heavy while it's still down, because it's way up now. So I was right to do that. I was going to put in the same amount over the course of the year, but might as well make it to where a lot of that is at the beginning of the year while the market's down. Their argument was, if you have a bunch of bonds and the market crashes, you won't watch your number drop as much, so you might not panic sell. And then when I just said, I'm not going to panic sell because I know not to do that. They're then countered with, oh, you don't know what you'll do because you weren't investing back when this happened. You're too young. You're just a millennial who thinks he knows it already, and you think you got it figured out, but just wait till it actually happens, and we're going to be laughing at all you guys talking this big game.
It's not like a guy has a pistol to your wife's head.
Yeah.
Like, no, I'm still not going to panic sell.
It's insulting. It's such a dumb argument to suggest that you're basically saying I have low emotional intelligence and I'm not able to understand my own behavior.
And not even recall the conversation you just had with them.
Yeah, I just don't understand why I would do it. It makes no sense. It's like saying how do you know if the gas station runs out of gas, you won't shoot yourself in the foot for no reason? That hasn't happened before, so how do you know? You don't. You can't know until you've done it, man.
You can't know until you don't have any gas, man.
Yeah, it's just a nonsense argument. I'm like, I understand the concepts here. I just wouldn't do it because it's stupid and doesn't make any sense.
That seems like that's something that a broker would do for their idiot client.
That's kind of what I started assuming. I'm like, yeah, you guys are just mad because your job depends on selling me things I don't need.
Yeah.
But yeah, so that's their argument and there's mine. And you can just go ahead and decide for yourself. Go ahead and look up their arguments. The only argument they were able to give me for why a person who isn't close to retirement should buy bonds is you could somehow trick yourself into not panic selling like a moron.
Plus, we all know
They said you don't know if you're people.
Just look up how well the butter in Bangladesh is doing.
But get this right. Here's something that Warren Buffett wrote in one of his public letters that he puts out there, and this is the advice to the inheritors of his wealth after he dies. These are his instructions, okay? My advice to the trustee couldn't be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost index fund. I suggest Vanguard's. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. So this is coming from one of the richest men in the world, the owner of Berkshire Hathaway, which is itself a big investment firm. And so now think for a second that Warren Buffett's advice to his heirs isn't even to put their money in his own company. The investment company that he owns, his advice to his heirs doesn't include it at all. His advice to his heirs is to put it into Vanguard. How crazy is that? And he only recommends to put 10% of it into bonds. Because when you're that damn rich, if the stock market tanks, that 10% that he has in bonds is still $8.4 billion. Now, you got to look at how much money do you have by that age. When you're getting close to retirement, that's when you need to ask yourself, how much should I convert to bonds?
That's $8.4 billion that he had when he bought it.
Yeah,
Not how much he would have when it crashed either.
Yeah. So if you're going to retire, let's say you've got $1 million at 60 and you're going to retire. If you did 30% of your retirement account as bonds, then that would mean that you had $300,000 in bonds. Can $300,000 last you, say, 2 to 5 years that a recession lasts? Can you live off of that for those years without having to sell those stocks?
God, I should hope so.
Yeah. So that's how much money do you have is going to determine how much bonds you need. You have to ask yourself, what percentage of my retirement account needs to be in bonds in order for me to make it through a 5-year recession? And you don't need to worry about that until you're close to retirement. Once you're retired, you should do rebalancing where if the stock market drops down, you just convert bonds into stocks because they're on sale. And then once the stock market's back up again, you convert stock back to bonds to get back to that previous ratio. So if you decided that you're going to go with a 30% ratio, but the market just dropped 20%, sell off a bunch of them bonds to buy stocks while they're on a discount. Then when the market's back up to where it was before, go ahead and convert back to however much you need to convert back to get back to 30% bond ratio. That's just a way to make money by doing contrarian investing.
Hustling, hustle.
Yeah. There's no way for you to know when the stock market's at its top, which is why you can't try and sell before the crash and all that shit. The people who try that are often very wrong, and that's why they fail to beat the market. But you can tell when it's not, and that's when it drops, and that it's going to go back up beyond that soon enough.
Right.
So to convert bonds into stocks when the market crashes, that's not the same type of market timing that causes people to lose money. That's just called rebalancing. And that's pretty much all I have to say about bonds. I don't own any at the moment because I'm only 29, and there's just no point.
All right. Well, that about wraps it up for this episode. And I was just thinking, with the popularity of things like stocking like weed, like marijuana crop, and like the gold standard, I feel like maybe those are things that we should touch on. What do you think about that?
Yeah, I can definitely talk about that for a little bit. Might as well throw Bitcoin in on that episode too.
Oh yeah, cryptocurrency is really big right now, and so look forward to that. And be sure to check us on all of our social media, like and follow our pages so you're updated on new episodes. And I'll see you guys later.
That money, 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 money. For that money, 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 money. That money, 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 money. Niggas turn on their brother. For that money, 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 money. That money, 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 money. For that money, money, money.